Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Tower Semiconductor.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we really jump into the charts today, I want to quickly mention StockOracle.
Right, which is an AI-aided stock research platform that we look at for some of this stuff.
Exactly. We've got a special 14-day trial link down below in the description for you. Now, just to be very clear up front, that is an affiliate link, meaning the channel may earn a commission at no extra cost to you.
Yeah, and we also need to emphasize that StockOracle is a research tool, right? It's not financial advice.
No, definitely not. It's not a trading signal service, and it doesn't give real-time market data. The AI insights and valuation estimates it generates, they can be incomplete or just outright wrong sometimes.
Always verify the important facts yourself before making any moves.
100%. Okay, so with that out of the way, let's talk about Tower Semiconductor.
Yeah.
TSEM. Because honestly, looking at this company right now is kind of like looking at a massive paradox.
Oh, it really is. It's one of the most fascinating setups in the market right now.
Right, because on one hand, if you just glance at some of the trailing metrics, you'd think they're actually shrinking.
Yeah.
But then you look at the stock price.
And it has completely exploded.
Exploded is almost an understatement. It's up by over 400% in a single year.
Yeah, that's just a wild number.
So today, we really want to tear into the center of this. We're going to cut through all the heavy financial modeling to answer one really crucial question for you. Is this specialty chipmaker's staggering rally actually backed by grounded fundamentals? Or, are we just staring at a highly engineered tech bubble?
It's the ultimate high-stakes valuation puzzle, really.
Yeah.
And the numbers we're dealing with here are, they're historic.
Yeah, historic is exactly the word.
You have to understand that in the semiconductor space, a 400% rally usually means one of two things. Either a company invented something that changes the world, or the market has completely lost its collective mind.
Right. There's very little in between. And just to paint the picture for you, the headline numbers jump right off the page. We are talking about Tower Semiconductor trading at around $252 a share right now.
Which is just incredible momentum.
It is. That's up an almost incomprehensible 417% from its 52-week low, which, by the way, was set just last August.
Just a year ago?
A single year. If you bought in at that low, you aren't just beating the market. You're playing a completely different sport at that point.
You really are. But a chart that goes straight up like that always carries a shadow, right?
Totally.
The higher it flies, the harder it falls if the underlying machinery isn't perfectly tuned. When you see a massive, dizzying rally like this, you have to immediately look past the stock ticker and look at the factory floor.
Because they can't just be selling hope.
Exactly. They have to be building something highly specific and, frankly, highly necessary.
Okay, so let's unpack what they're actually building. We need to figure out what is driving that explosive growth on the ground. Because, usually when you read the headlines about semiconductors, it's always these massive titans fighting over cutting-edge processing nodes.
Right, the battle for the smallest nanometer.
Yeah, exactly. They're spending tens of billions of dollars to make transistors with just infinitesimally smaller. But Tower isn't really playing that game, are they?
Not at all. And that's the key to their whole story. Tower is a pure-play foundry, meaning they manufacture chips for other companies, but they took a completely different path than the giants.
Right.
Instead of fighting that massively expensive war for the absolute smallest digital chip, they focus on specialty analog processes. They found a very specific niche.
And what's the star of that niche right now?
Well, the undisputed star of the show right now, the core engine driving this massive rally, is a technology called silicon photonics.
Silicon photonics.
What's that?
For CFO.
Yeah.
CFO.
It's fascinating tech.
When I was looking into this, my mind immediately went to traffic and infrastructure. Because think about traditional data center connections, right?
Yeah.
You have copper wires moving electricity.
Which works, but only up to a point.
Exactly. It's very much like a crowded, aging highway system. You can only put so many cars on the road before everything just grinds to a total halt. The data just can't move fast enough. And the heat generated by all that electronic friction is massive.
Yeah, the heat is a huge bottleneck.
But silicon photonics, on the other hand, is kind of like ripping up that congested highway and building a high-speed bullet train network that moves data using literal light.
Right, using lasers.
Yeah.
Yeah.
It integrates lasers and optical components directly onto the silicon chip itself.
That analogy perfectly captures the physics of the problem, actually. You are literally replacing electrical friction with optical speed.
Which is everything right now.
It is. In this current era of artificial intelligence, data centers are processing just unfathomable amounts of information. The processors themselves are incredibly fast, but the connection between them, that highway bottleneck you just mentioned, that is the single biggest problem the AI industry faces today.
It's like having a Ferrari engine, but you're driving it in rush hour traffic.
Exactly. So moving data with light directly solves that AI bottleneck. It drastically reduces the heat, it slashes the power consumption, and it increases bandwidth exponentially. I mean, you literally cannot build the next generation of AI supercomputers without it.
And the numbers backing this up are just wild. Looking at the data, Tower's Silicon Photonics annual run rate revenue surged from $180 million in the second quarter of 2025 to a massive $680 million in the second quarter of 2026.
We should really let that sink in for a moment. I mean, that is massive triple-digit year-over-year revenue growth. And remember, this is a highly complex physical manufacturing niche.
Right, this isn't an app.
Exactly. It's not a software product where you can just copy and paste code to meet demand. They are physically manufacturing these intricate optical components at scale.
Which is incredibly hard to do.
Very hard. And that incredible jump in silicon photonics led to a record Q2 overall revenue for the company of $460 million, which is up 25% year over year.
Wow.
Yeah, alongside a record net profit of $91 million.
So they're essentially printing money right now.
Well, the current revenue is definitely strong, but the real reason Wall Street is so aggressively bidding up this stock is the moat.
The competitive advantage, yeah.
Right. Tower has deep, entrenched, multi-year expertise in silicon photonics. They aren't just suddenly jumping on an AI trend. They have secured customer-anchored capacity expansions.
Meaning the customers are already locked in.
Exactly. That gives them a highly defensible competitive advantage in AI-driven optical connectivity. If AI is a gold rush, Tower is manufacturing the picks and shovels.
But they are making those picks and shovels out of lasers.
Exactly, out of lasers.
I love that visual. But hold on, I need to push back here a little bit.
Yeah.
Because when I was going through the numbers, I found a pretty glaring contradiction. I actually mentioned it at the top of the show. And to me, it's a massive red flag waving right in the middle of all this optimism.
Let's hear it.
If business is absolutely booming, right? If they are making record profits and seeing this triple-digit growth in silicon photonics, why is the trailing 12-month revenue growth, the TTM, sitting at negative 12.59%?
Yes. The TTM disconnect.
Yeah, I mean, how do you have a stock up 417% when the trailing revenue growth says the company is shrinking by over 12%?
Look, any skeptical investor looking at a stock screener would ask that exact question. It looks like a massive, irreconcilable disconnect on paper. But the secret lies in the mechanics of the metric itself.
Okay, walk me through that.
Well, the trailing 12-month figure is, by definition, a lagging indicator.
Right.
It is dragging in the weaker past quarters from before this current massive demand surge in silicon photonics truly materialized and hit the balance sheet.
Oh, I see. So it's kind of like looking in the rearview mirror while aggressively accelerating on the highway.
Exactly.
You are seeing where you were, not how fast you're going right now.
That is a great way to frame it. That negative TTM includes quarters from late 2024 and early 2025 where the capacity and the demand were, they were still ramping up. And legacy parts of their broader business might have been slower at the time.
So it's dragging down the average.
Right. The market isn't pricing Tower based on what they did 18 months ago. The market is pricing them based on forward guidance. And that forward guidance is record-breaking.
Like what kind of numbers are we talking about for the forward guidance?
They are projecting Q3 2026 revenue to hit $520 million at the midpoint.
Wow. Okay.
Yeah. That represents a 31% year-over-year growth for the upcoming quarter alone. So the narrative has completely flipped from contraction to hypergrowth.
Okay, so the future looks incredibly bright.
Right.
But to meet that kind of explosive forward demand, they have to physically build the capacity. Like you said earlier, you can't just wish these chips into existence.
Right. You need physical space, machines, everything.
And that shifts our conversation from revenue growth to the sheer staggering costs of scaling a semiconductor business. Because they're launching a massive capital expenditure program. We are talking about $900 million to $1 billion across 2025 and 2026.
That is a huge amount of capital.
Just to expand their 8-inch and 12-inch wafer plants, they're building out in Israel, Newport Beach, Texas, and Japan. I mean, they are targeting a 5 times capacity increase.
A 5 times increase in the short to medium term is just a monumental physical undertaking. Building or expanding a semiconductor fab involves specialized clean rooms, billion-dollar lithography machines.
Yeah, it's not like opening a new office building.
Not at all. It involves incredibly complex supply chains just to get the factory operational before a single chip is even made.
But think about this from a normal budget perspective. If a company suddenly announces they are going to blow $1 billion on new factories, basically blowing out their free cash flow in the near term, why isn't that a massive red flag? Usually that kind of cash burn terrifies the market and tanks the stock price. Why is Wall Street cheering for $1 billion expense report here?
Well, it generally terrifies the market when the spending is speculative.
Speculative, right?
When a company builds a factory simply hoping customers will show up, that is a massive risk. But the key detail here is that this heavy capex is directed at validated growing customer demand.
They aren't just guessing.
Exactly. The expansion is customer anchored. That means clients are already lined up for the capacity before the concrete is even poured. Furthermore, to ease any concerns about them burning through cash and over-leveraging themselves into bankruptcy, we just have to look at the credit agencies.
What are they saying?
S&P recently revised Tower's outlook to positive from stable, and they affirmed their ILA credit rating.
Okay, so S&P is basically looking at their balance sheet, looking at the billion-dollar price tag, and saying, yes, they are spending a fortune, but their financial foundation is absolutely rock solid.
Right. An ILA rating indicates very strong credit quality. It means they have the cash reserves, the operating margins, and the financial health to survive this heavy investment phase, provided the customer demand holds up as projected.
So the cost of scaling brings us naturally to the next massive piece of this puzzle. We've covered the staggering growth of silicon photonics, and we've covered the billion-dollar bet to build the factories. Now we have to look at how the market is valuing those future bets today.
This is where it gets really tense.
Because, wow, you want to talk about demanding expectations? Tower Semiconductor currently trades at a blistering 98.37 trailing price-to-earnings ratio.
Yeah, a 98 PE ratio puts you in very rarefied air, even in the tech sector.
To put that in perspective for you, the market cap sits at $28.5 billion. If you buy this stock today at a 98 PE, you are paying $98 for every $1 of trailing earnings the company generated.
This is steep.
You are not buying the company for what it is today. You are paying upfront for years and years of flawless, uninterrupted future growth.
Which perfectly explains the heavily divided market sentiment we are seeing right now. The analyst community is looking at the exact same data and coming to very, very different conclusions about what happens next.
Yeah, I saw that.
On one hand, you have BofA Securities. They just initiated coverage on Tower with a buy rating and a price target of $367.
$367. That implies another 45% upside from where the stock sits today.
Exactly.
BofA is essentially saying, yes, a 98 PE is expensive, but the optical bullet train is moving so fast and AI demand is so insatiable that the valuation will compress as earnings catch up.
That is the ultimate bull thesis. But on the other hand, you have analysis from platforms like Seeking Alpha flashing bright warning signs.
What's their take?
Well, they acknowledge the excellent fundamentals and the brilliant positioning in silicon photonics, but they warn that this extreme valuation already bakes in management's lofty 2028 target of $2.84 billion in revenue.
Okay, so if I'm synthesizing this tension correctly, it means that at $252 a share, Tower Semiconductor is priced for absolute perfection.
Pretty much.
They have effectively zero room for execution errors. If they miss a step, if a factory in Japan is delayed by a month, if a major customer pushes an order back a single quarter, what happens?
The stock could face a severe derating. The valuation demands absolute conviction in the growth thesis, and it demands that management executes flawlessly over the next 2 years. When you trade at nearly 100 times earnings, the market is completely unforgiving of any operational hiccups.
But a 98 PE ratio means they're walking a tightrope without a net. If the wind blows, they fall. So what does that wind look like? What actually threatens this setup? Because we were talking about a company priced for perfection in a world that is rarely perfect.
Right, and the biggest gust of wind usually comes from outside the company's control, specifically the global supply chain. There are several critical risks here. The first major external risk involves geopolitics.
Okay.
Specifically, the Trump administration has proposed massive tariff increases on Chinese products.
And it's really important to look at these proposed tariffs not as a political issue, but strictly through the lens of supply chain mechanics, right?
Exactly. We have to be impartial here.
Yeah, if borders get sticky, complex components get delayed, regardless of who is in office. We are merely analyzing the potential market impact of proposed trade policies on a global manufacturing company.
100%. Through a purely economic and logistical lens, any massive tariff increases on Chinese products introduce significant friction and uncertainty into global semiconductor supply chains.
Because semiconductors are arguably the most complex, globally integrated products on Earth.
Oh, without a doubt. The raw materials, the fabrication, the packaging, the assembly. These components cross dozens of international borders before they become a finished server rack in a data center. And if Tower isn't manufacturing in China themselves, they exist within that fragile ecosystem.
Right.
If new tariffs disrupt customer demand patterns or slow down the flow of underlying components, Tower will absolutely feel the ripple effects.
Because if the whole ecosystem slows down, the demand for their specialized light-speed chips slows down with it.
Yeah.
They can't sell a faster engine if the factory building the rest of the car is stalled by trade disputes.
The friction cascades, it always does. And speaking to the physical location of their assets, the second major risk highlighted is regional. Tower has a significant manufacturing footprint in Israel. While they have major operations in the US and Japan to diversify, their Israeli plants are crucial to their current output and their expansion plans. That carries inherent regional geopolitical risk that is, frankly, unquantifiable on a spreadsheet.
It's an unknown unknown.
Exactly. It represents an overhang that could materialize unexpectedly and disrupt production.
So we have macro supply chain risks and regional risks. But what about the people who actually run the company, the insiders? Because looking at the data, over the last 90 days, insiders had a net selling of negative 36,312 shares.
Yes, the insider selling.
Yeah. And, when the people inside the house are selling, shouldn't the people outside the house be running for the exits?
We have to carefully contextualize that number, though. In isolation, insider selling is generally viewed as a modest negative signal. But let's look at the reality of the situation here. The stock is up 417% in a single year. If you worked at this company, had equity as part of compensation, and suddenly saw your net worth quadruple, wouldn't you take some chips off the table?
Honestly, probably buy a boat. Or, at least diversify my portfolio a bit.
Most people would. It is largely just natural profit-taking. Furthermore, the data shows the activity was split perfectly evenly between 10 buys and 10 sells.
So it wasn't a coordinated dump by the entire C-suite.
Not at all. And in the context of a $28.5 billion market cap, 36,000 shares is a drop in the ocean. It's a mild yellow flag at best. You monitor it to see if it accelerates into an exodus, but right now it is not a strong negative signal indicating structural problems.
Okay, so if I'm holding this stock or thinking about buying in, I'm staring at a company with massive momentum, a billion-dollar expansion plan, zero room for error, and a bunch of macro risks. How do I actually keep score over the next few months? What should we actively watch for to see which narrative actually wins out?
You need a very specific scorecard based on the catalyst calendar. The upcoming few months give us 3 clear tests.
Okay, what's number 1?
The first and most immediate test will be their Q3 2026 earnings expected in early November.
The moment of truth for that forward guidance we discussed earlier.
Exactly. Management set a guidance midpoint of $520 million in revenue, but the broader analyst consensus is sitting a little lower, around $490 million.
Oh, interesting.
So the question is, can Tower hit their own ambitious target and beat the street? A beat and raise here would directly compress that scary 98 PE valuation risk by proving their earnings power is accelerating as fast as they claim.
And if they miss?
If they miss, the stock will likely be punished severely.
Yeah, that makes sense. And what's the second milestone on the scorecard?
The Q4 Silicon Photonics milestone. Management has publicly targeted crossing the $1 billion annual run rate for the SiPho business by the end of 2026.
$1 billion run rate just for that one segment.
Yes. Confirmation that they have crossed that threshold would be a massive positive catalyst. It would validate the entire growth thesis underpinning their long-term 2028 targets. It proves the demand is durable and scaling.
They basically need to prove the bullet train is actually hitting top speed and the tracks can handle it.
Perfect analogy.
And the third item on the watch list.
Margin expansion. We spent a lot of time talking about how much money they're spending on these new factories, right?
$1 billion, yeah.
We need to see if that spending is translating into operating efficiency. Currently, their adjusted EBITDA margins are around 35%. Management says they are targeting an expansion toward 40% as they sell a higher volume of these high-value silicon photonics products.
So even incremental evidence that their margins are inching up toward that 40% will be highly constructive for the stock.
Exactly, because margin expansion shows operating leverage. It means they aren't just selling more volume, they're actually making more profit on every single chip they sell as they scale up.
Okay, let's bring this all together. What is the final verdict here? After weighing the explosive growth against the massive valuation, what's the score?
Well, the overall rating lands at a 7, which is categorized as measured bullish.
Measured bullish, okay.
Right. The fundamental growth is undeniably real. The triple-digit growth in silicon photonics, the record profitability, the customer-anchored capacity expansion, it is all incredibly strong evidence of a healthy, dominant business carving out an essential niche in the AI revolution.
There's always a catch when a stock is up 400% in a year.
There is. The heavy capital expenditure and that 98 PE valuation demand incredibly high conviction from investors. It leaves minimal room for execution error. It is a measured bullish stance because while the trajectory is excellent, the price of admission today requires Tower to operate flawlessly in a very complex, unpredictable global supply chain environment.
So for the long-term view, it essentially means Tower has built a bullet train, the tracks are laid, and the passengers are lining up down the block.
Right.
But they are charging an absolute premium for the ticket right now, and they cannot afford a single delay on the route.
That is the perfect summary.
It's been a fascinating journey unpacking this today. But before we wrap up, I want to leave you with a final thought to ponder on your own.
Let's hear it.
We started by talking about how gravity is defying this stock chart and how the massive data center demand is driving it all. As the artificial intelligence revolution demands exponentially more power and faster optical connectivity just to function, could highly specialized niche foundries like Tower Semiconductor, the company's actually building the physical laser connections, could they eventually hold more leverage over the future of data centers than the massive household name chip designers we hear about every day?
That's a huge question.
Right. The designers dream up the AI, but foundries like Tower have to physically make it possible. Where does the real power lie in the future of the internet? Something to think about. As a quick reminder, don't forget to check out the description for that 14-day trial link to StockOracle. It's an affiliate link, but again, it's a great tool if you want to dig into these AI insights yourself. Just remember to verify the data. And please consider subscribe, like, and comment underneath if you enjoyed this.
We'll see you next time.
Thanks for joining us. We'll catch you on the next one.